John Schoenberg. I'm the Chief Investment Officer at Stonebridge Capital Advisors. No two clients have the exact same investment objectives. So at Stonebridge, we really try to build unique portfolios for each individual that meets their specific objectives. After sitting down with each individual client, we then meet as a portfolio management team on a daily, weekly, and monthly basis to do our fundamental research to really decide what individual stock and bond is appropriate for each individual's account. A lot of investment advisors build portfolios of mutual funds or ETFs, and they don't use individual securities to build that portfolio. We think that there's a huge advantage using individual stocks and individual bonds to build that portfolio. We're basically building a mutual fund in a separately managed account, not using mutual funds to build an account. So when we build a portfolio, we're really investors, right? We are looking for a name that we think is going to outperform, whether it be a stock or a bond, for the next 3, 5, 10 years. It's truly an investment. It's not a trade. We're not trying to find a name that's going to go up 100% tomorrow. We're trying to find a name that's a leader in their industry that's going to do well over the long term. When it comes to hiring an investment manager, the most important thing to an individual or a corporation is trust. Trust that you're going to do the best for them over the long term.
Welcome to the 2021 Stonebridge Capital Advisors Educational Forum. We're excited to have you here and thank you so much for joining us today. To be fair, we'd love to have you here face-to-face with us as we had planned, but for safety reasons, it was more important to care about you, make sure you were safe, and so we're providing this live stream as well. We'll be recording it so you can go back to it and review it on our webpage as well. But again, thank you for joining us today. We really appreciate it. Today, we'd like to review a few things, one of which is we are growing, and we're growing to serve you better. And Heidi Huckreed will be coming up here shortly. She is now our Chief Operations Officer. We'll be talking about some of the changes that we're making relative to our operational capabilities, particularly on the client relationship and operations side of our business, which has been an important part of our business for a long period of time. We'll also have Dan, our economist. Where is he? There he is. Dan Laufenberg will be giving what is always an entertaining economic review. And John Schoenberg will come up shortly after that, talk with you a bit about the equity side of the markets. And John Lynn, who is now our Director of Fixed Income, will be joining us to discuss the fixed income side of our business. So we're anxious to look forward to that. But right now, what I'm really excited to do is introduce you to an organization that we've been affiliated with for quite some time, but particularly the last year. We've partnered with Matter, which is an unbelievable organization that does fabulous things for people, quite frankly, all around the world. So I'm going to introduce Victor Salamoni, who will introduce you to Matter, and by the time you're done, you'll know you matter. There you go, buddy.
Thanks so much, Bob. We are so honored to have been elected to allow us to serve Stonebridge Capital Partners. Patrick, Bob, thank you so much from all of us at Matter. We are an organization that's been around for 20 years. We are an international NGO, and so we are working in about 78 countries around the world, but predominantly locally. And so just to give you a little information, last year was a very crippling year for nonprofits, and it really shows that you have to be nimble and be able to handle the situations that come your way. We were predominantly an event-driven company in which people would gather and pack and get product out to the community. Well, we had to change our model, and we came up with a product called Volunteer Kits. And this product alone has really sustained a lot of corporations, companies, organizations, and individuals of how to give back to your community. And so we are honored that Stonebridge Capital Advisors actually came and volunteered. We had kits sent to their employees, and they contributed to the community. To give you an understanding of what we did in the community locally, We served about 250,000 people in 2020. We had about 9,000 volunteers, whether they were in their homes or they came to our facility, which is an essential facility. We provided impact, access to health to over 3 million people around the world. So thank you so much for allowing us this opportunity. We hope that we can meet anyone and everyone on this video and perhaps set up a program with them for the volunteer kids. Thanks so much again, and I appreciate our partnership with Stonebridge Capital Advisors. Bob?
Thank you, Victor, so much. You didn't say you matter. Did I hear you say that? Come on, just come on back up here. This is one of their favorites.
It is something that we say to all of our people, and on the count of 3, we want to hear you say it passionately.
Definitely.
1, 2, 3. You matter. Thanks, Bob. I appreciate it.
Thank you. Amazing organization. If you have a chance, look it up. It's worth participating in. So now I'm happy to introduce one of our founding partners, and most all of you know Heidi. She's been fabulous with us. And more recently, she's been promoted to our Chief Operating Officer, and well-deserving as such. And so she's going to tell you about some things that we're excited to introduce you to, an expansion of our client relationship team and the things that we're doing there to serve you better. So Heidi, there you go.
Thank you, Bob, and thank you, Victor. From a personal standpoint, I have had the opportunity to volunteer with Matter, and what they do is amazing, and it really does matter to our community and worldwide. So thank you, Victor, and your team. As Bob said, I'm here to update you on our growth and what we are doing to help serve you better. As you all know, client service has been really a cornerstone of why we developed Stonebridge and has brought us through the years. You are our growth. Our relationship with you, our clients, and our advisor partners have created this growth, and we thank you so very much from the bottom of our hearts. On that note, as we have navigated this growth, obviously client service takes a bigger and bigger team to impact what we do for you. So under the direction of Elise Rogers, our Director of Client Relations, she has created a team with Rachel Nault and Mitch Cornelson, our Client Relations Specialists, to serve you better. She is really creating and improving all of the client service aspects that we provide to you in order to make your client experience the best it can be with Stonebridge. Given the growth that we've had at Stonebridge also, about a year ago, I'm going back that far since we weren't able to have a client event last year, we added Brad Stone as a portfolio manager to our portfolio management team. He is located in our Denver, Colorado office, along with Derek Watson, has made some wonderful contributions to our team. So we thank you, Brad, also for joining us. And again, on the growth topic, with all the growth we have seen, we determined that it would be best to add an administrative services arm to Stonebridge to support all aspects of the business, whether it be client service, marketing, client portfolio management, or anything that we need to do for our clients. That is under the leadership of Lori Wessel, our Chief Administrative Officer. And obviously you all know Michelle Turkowski. She is our Client Relations Administrator. We have hired this summer two new people to our administrative team. And so in June and July, we had Bonnie Romano, who is our administrative coordinator, and John Unmacht, who is our client service and sales administrator, join our team. We're very happy to have them on board. In a very short period of time, they've made a significant contribution to the support of all of our teams, so we really appreciate them as well. All of this is done, obviously, as Bob mentioned, to improve your client experience, to maintain and improve the client service that we provide for all of you, and to really improve our relationships and continue our relationships with you for years to come. So I just wanted to give you that in a nutshell. And with that, the main event of the evening, I'd like to bring on stage our esteemed chief economist, Dr. Dan Laufenberg, who will give his economic update. Thanks, Dan.
Well, thank you, Heidi.
You're welcome.
I am delighted to be here again. I'm sorry that you're not. The economy is doing really well. At least it did in the first half. It's probably going to do well again in the second half, but not as well as it did. I'm here to give you two things. I'm giving you the economic outlook, which is still pretty positive. I'm here to also give you an economic forecast. So the forecast actually involves some numbers. So I'm going to have to give you a few numbers just to make you feel good. In the first half, it looked like the economy grew over 6% at an annual rate. That we measure growth by looking at real gross domestic product. Real gross domestic product is the most comprehensive measure of economic performance that we have, which is one of the reasons why economists like it. And you hear about it all the time. If you turn on any of the financial news networks, they are focused primarily on gross domestic product, GDP, real GDP, adjusted for inflation. What is it doing? What's the outlook? What do we expect going forward? So the economy grew a little over 6% in the first half on average of the 2 quarters. In the second half, I think it's probably going to grow a little over 3%. Now, that sounds like a pretty significant slowdown from 6 to 3. But you have to remember that 3% is still well above the trend over the last 20 years. So we still have an economy that's doing reasonably well. What's going to be driving growth in the second half? It's not going to be what you might expect. In the first half, consumer spending was out of sight. It was skyrocketing almost 11, 12% for the first half of the year. You're not going to see that in the second half. In fact, the third quarter, the consumer sector is probably going to slow down, as evident by motor vehicle sales. Did you see what happened to motor vehicle sales in the last first 2 months of this quarter? They're down 55% at an annual rate already. So you're probably going to see a bit of a bounce, but it's not going to be enough to sort of give yourself any kind of a stellar consumer sector for the third quarter. We do expect a little bit of a rebound in the fourth quarter, so we expect the consumer to do a little better in the fourth quarter. That's sort of a bounce from what they sort of gave back, given what they did in the first half. Wasn't sustainable. They had to give some of that back. What's going to hold up growth in the third quarter, I think, is going to be inventories. We had a huge liquidation of inventories in the first half of the year. Those inventories are going to have to be rebuilt, and I think it's the third quarter. And this is evident not only by the fact that consumer spending may be down. We had retail sales today, looked like retail sales, we are going to get a little bit of a bounce, so it's not going to be as bad as July suggests, but it's still a slowdown from what we had, a dramatic slowdown from what we had in the first half of the year. But we see that industrial production is continuing to move up. We are seeing some pretty decent production numbers, which suggest that we're still producing goods. They have to go somewhere. If you're not buying them, they go into inventories. Inventory still adds, a change in inventory still adds to growth. So real GDP is still going to be up, still going to be up 3%. It's just that the source of that growth is going to be far different than it was in the first half of the year. In the fourth quarter, we expect real GDP to look a little more consistent. You'll have GDP growth that will be driven primarily by consumer spending growth once again. So we are looking for a rebound. Now, there are assumptions that are associated with this forecast. The 3 assumptions that I make are inflation doesn't really become a huge problem. So interest rates, the Fed's probably going to be very slow about tapering. And we think that they are going to taper before the end of the year. But the tapering, when I talk about tapering, I mean stop buying some of the bonds or mortgage-backed securities that they've been buying for their portfolio, stop putting money into the system to the extent that they have. So they're going to pull that back a bit. They're going to reduce the amount of purchases that they make for those particular securities. We think they're going to hold up on the treasuries. They're going to still buy treasuries. We've really become addicted to a low interest rate in the treasury market. So I doubt the Fed's going to pull back dramatically there until they see something far more severe than what they're anticipating. But they might start to pull back a little bit on the mortgage-backed securities that they've been buying. So I think that's one of the areas that we might see. The other assumption is that coronavirus, the Delta variant or any other variant that might come along, isn't going to be a huge problem for the economy in the second half. It might be a bit of a drag, but it's not going to be the problem that that many people might fear. But it's going to be there. It's something that's probably going to hold it down from where we might have expected if things were better. But we do have a vaccine. Hopefully, people will take the steps they need to protect themselves from the virus. The third assumption is that there is going to be a government spending program initiated. We think it's going to be an infrastructure spending program, so there is going to be a boost to GDP coming from the government sector in that regard. By the way, when the government sends you a check, that's not government spending under the definition of GDP. That's income that goes to the pocket of the consumer who then spends it. So it's when the consumer spends it that it shows up in GDP, not when the government sends you the check. But if the government spends money on highways and railroads, terminals, airports, anything like that, any kind of public goods project, public works projects, that's actual spending on goods and services. And so that's going to show up in GDP. So that will be a boost to the GDP number, not necessarily coming through the channel through the consumer side. So those are the assumptions that we're making. In terms of GDP, we expect to do reasonably well, but you might ask the question, well, why are you concerned about real GDP anyhow? We're growing, we're going to continue to grow, the expansion is underway. Who cares? Well, you think about it, if you're going to grow fast, then there's a good chance you're going to need more jobs to produce those goods and services that you're going to be producing. So if the economy is growing at 3% rather than 6%, 3% is slower than 6%, you're still going to get jobs from 3%, just maybe not as many jobs as you got from the 6%, but you're still going to get jobs. So job growth is going to continue. It's going to slow down. I don't know why anybody or everybody panics when you see that job growth is slowing down from one month to the next, because it is. It has to slow down. You're going to see slower job growth, but you're still going to see enough job growth to get the unemployment rate to continue to drift lower. The unemployment rate is probably going to get down to 5% or maybe even lower by the end of this year, and certainly lower than that next year. So the Fed, if it's focused on jobs, if it's focused on the unemployment rate as one of its mandates with respect to its policy, then what happens to the unemployment rate, what happens to jobs, is very relevant to what monetary policy might look like. It might be even relevant to what fiscal policy looks like. To what extent do they need a new spending program, bill legislation? How much is that going to be? How big does it need to be to get the job done? So that's one of the things. The other thing is inflation. There's a lot of concern about inflation getting out of hand. By the way, if you're waiting for inflation to get out of hand, you missed it, because it got out of hand last quarter. In the second quarter, the consumer price index was up 8.2%, I think it was, at an annual rate. It was certainly above 8%. If you get the number that was reported today for August, you just look at July and August, and if prices are unchanged in September, I mean, they don't have to go up, they just stay where they're at in September from where they were in August, you're going to get a 6% annual rate of growth of inflation in the third quarter. And core, if you exclude food and energy, which economists like to do, only because it gives them a better feel for what the fundamentals look like, you're still going to get 5% inflation in the third quarter. So it's not just food, it's not just energy, it's broader than that, and it continues into the third quarter. Will inflation slow down? Yes. Is it transitory? The Fed likes to say, well, it's transitory. It's not going to last very long. Inflation is going to get back down to our target of 2%. Well, maybe it does. Let's say that inflation does get down to 2%. It probably isn't right away. It's probably going to get down to 3%. But let's say it gets to 2%. That's their target. 2% is their target. So if that's normal for the Fed, if 2% inflation is normal for the Fed, where do you think interest rates ought to be? Interest rates ought to be someplace close to normal. I would say that zero in short-term interest rates at zero is not normal. I would suggest that you're probably going to see higher short-term interest rates. Not right away. The Fed's going to have to be convinced that it's not going to go lower than 2%. They certainly don't want inflation to go to 1% again. But if it doesn't, then I think the Fed's going to have to be doing something, and they're probably going to be doing something sooner rather than later. So that's one of the things that we look at. So when you talk about GDP, it has a much broader implication, because to produce goods and services, for that to grow at a 6 or 3% pace, you're going to need jobs, because the only way you increase output is by either creating more jobs, working more hours, or being more productive when you are working. And if you assume that productivity is sort of okay, then you still need jobs to produce GDP. So the job market is still going to do well. You're going to generate employment. You're going to see the unemployment rate continue to go lower. Inflation, same thing. GDP, if you grow faster, what happens? Well, generally, when you have fast growth, demand is outstripping supply. You can't produce goods fast enough to satisfy the demand. Demand pulls those or pushes, I think pulls. It pulls the price up. Demand pulls the price up. So you're going to get higher prices, you're going to get inflation. By the way, I got to stop. Inflation isn't just a high price. Inflation is higher prices. So prices have to keep going up for inflation to keep going up, or to stay even at 3%. It's got to continue to see price increases. So the Fed's going to be focusing on that. They focus on GDP because it does have some implications for inflation. In fact, when people say, well, there's supply shortages, you can't get the supplies. And yes, the pandemic probably had a contributing factor to that in some regards. But it's also the fact that if you have demand that's growing so fast, you just can't get the parts fast enough. And so prices go up, and prices act as a little bit of a governor on this, because if your prices start going up too much, then people are going to start to pull back. You already see some declines in motor vehicle sales. You're already starting to see some slowdown in housing. You're seeing those things because prices have sort of got to levels where it starts to hurt. So you need to have additional income. You need more jobs. You need to get that demand sort of keep going before you really see that trigger. But I would say that you don't need 8% inflation to get the Fed to raise rates. I would say that if you continue to get 2% inflation, probably 2.5%, you're going to see the Fed do something, because they're going to assume that we're back to normal, whatever that might look like, certainly in terms of inflation, which means that monetary policy is going to be normal as well. And normal isn't zero on short-term rates, and certainly not zero. It's not normal with 1.3% 10-year yield. It's going to be higher there too. So that's basically my story. It hasn't changed much if you've been reading my stuff. It's been hard to write the forecast update simply because it hasn't changed that much. And so when it doesn't change, it looks like it's right, so I don't have much to say. But if it's wrong, I always have a lot to say. So you're probably happy that I don't have anything to say. So here I'd like to introduce Bob. You again? Sure. All right.
Thank you, Dan.
You're welcome.
Great job, buddy. I know you'll have questions for Dan as we get going, so we'll make sure we get those questions to him. But right now, I'd like to introduce our Chief Investment Officer, and I think most of you know John. John Schoenberg has been our Chief Investment Officer for a while. This has been a big year for the investment team in restructuring themselves and creating some more efficiencies in how particularly we trade our portfolios. A lot of great work has been done by our team during the course of 2021. I know John's going to go over that a little bit, as well as talk about what we see happening in the equity markets, and then I think he'll pass it on to John Lynn to talk about the fixed income markets. So John, thank you, sir.
Thank you, Bob. I thought, given our backdrop here, he was going to say, "Here's Johnny." So maybe Bob, you can play the role of Karnak later during Q&A, given the stage. But I wish everybody was here in the room with us. It was 2 years ago when we had our last live client event, and it's always more fun to have people in the room asking questions. I really appreciate Dan's words tonight. The equity markets have been challenging. It was 2 years ago, we stood in this room, the same room, and talked about a slowdown in the US economy. And Dan was feeling that the economy could slow somewhat rapidly as we headed into 2020. Dan was absolutely right. What Dan didn't see was the pandemic that was going to follow soon thereafter, which took us into a really tough market environment into March of 2020. Tough times. I would say the one thing we had done was we started to position our client accounts a little more conservatively. We thought it was time for clients who had had a big move in the equity market to adjust their position sizes in stocks versus fixed income, and really look at their overall risk tolerances to maybe reduce their allocation to equities. We did that in many cases as we headed into March. What we didn't see coming was the Fed's response to that pandemic and throwing $2 trillion at the US economy made it really the quickest recession that we've had in the history of the United States. And things had fully recovered by August of last year, and it's been really nonstop since March of 2020. The markets have recovered very nicely. I think the S&P is up over 70% from the lows in March of 2020. And even year to date, the S&P 500 is up over 20%. So the markets have been very healthy. It's also taken us to a level again where people should look at their risk tolerances and say, okay, I'm back above where I was before all this started. Do I have the right asset allocation for the equity markets versus other asset classes? So that's a note to always be vigilant on that. I will say it's been tough to manage money in the equity market. It reminds me a lot personally of managing money in 1999 and 2000, where everything just kept going up and up and up, and it didn't really matter what was happening for the individual companies and the overall economy. The trend was just up. So what's causing that? It's really demand, right? The supply of stocks out there in the world is a fixed supply with some IPOs, but the demand for equities is very high. Why is that? Well, interest rates are very low. So when you look at allocations that corporations and people make, you used to be able to get a 4 to 5% return in the fixed income market. You can't get that now. So the demand for equities and dividend income paying stocks has risen, and the supply has gone up a little, but not as fast as the demand. So we really feel today it's been a real demand-driven equity market, supported by an economy that's gotten much better. So it all makes sense to us. The good news is when we got defensive in 19, we took people down to their kind of equity targets. We didn't get super negative and super defensive. So I would say for the most part, our clients in their portfolios have done well over the past 18 months and participated in the rally of the US equity market, which is a good thing. There is a problem though when people come to us with cash and they want that money put to work. We look at many stocks that's selling at all-time highs. It's been a difficult process for us to continue to commit new cash at these very high levels. We do think that the market is overdue for a correction. I'm talking about a solid 8 to 10% type of correction. We aren't talking about a bear market. We had that. It was in March of 2020. It was a quick one, but it already happened. We think, like Dan thinks, we are in an economic expansion again, and equity prices, barring a correction, are going to continue to rise for the foreseeable future. Now, things could happen that would change our opinion, but I really believe, and we believe, that the US economy is continued to grow. I mean, Dan talked about a slowdown from 6% to maybe 2%, but it's still 2% positive economic growth. That's not recessionary. That's a solid base for a good equity market going forward. So we're pretty optimistic that equities will continue to perform just fine, barring a correction. I think everybody would like to see a correction, a good solid 8 to 10% correction. We'd be able to put some more cash to work in client accounts, and putting new money to work would be easier. And that can happen in any moment. We won't know why. It could be, September, October, seasonality, but you can't see a correction coming. It just happens and then things recover. So our positioning is still optimistic. We think we're in the early stages of an economic cycle that's going to propel the equity market higher. That said, there are pockets in the market that we think are a little bit overdone, but a lot of those have already corrected. I mean, even the environmental sensitive stocks that were all the rage 6 months ago have all kind of pulled back to a more reasonable level. So we think that overall the market's going to continue to do just fine, and we are positioned for that. That said, it goes back to what I said earlier. It all depends on your personal risk tolerance and your objectives. And if you've seen this market that's up 70% from March and equities have become a bigger part of your overall portfolio, it could be time to reallocate into fixed income or a safer asset class. And with that, I'm going to introduce John Lynn and have him come up to talk about the fixed income market and what we're seeing there. And then we'll be happy to answer any questions you may have on the markets in general. So, John?
Well, this is going to be an interesting discussion because I'm going to touch on a lot of points that John did, but I think from a more fixed income perspective. But really, I'm going to acknowledge a lot of the same points. But first of all, I just kind of want to get it out of the way that bond yields are pretty boring right now. I think all of us have been living through this for the last few years, so we're well aware that that rates are low and they don't really seem all that attractive to us as fixed income investors. But that said, I think that some of the points that I'm going to cover here are that's okay. It's okay to still invest in bonds. So I'm not going to talk about where absolute rates are, what credit spreads have done. What I want to do is really kind of focus on a couple of key points. The first one being, how did we get here fixed income wise in this current environment? The second is credit quality, the credit quality that we're seeing out there in the fixed income markets. The third thing, what is our strategy? How are we dealing with the current environment? And then the fourth thing kind of ties some of the first couple of points together, and it's really kind of encouraging people, somewhat like John was saying, to kind of reevaluate your portfolio, make sure that your objectives are being met, and that you're not taking on more risk than you're comfortable with. So that being said, how did we get here fixed income wise? I think over the last few years with interest rates being as low as they were, and the Fed keeping the short term really anchored, that's moved a lot of traditional fixed income investors more towards dividend income stocks and probably at the lower end of their fixed income range. And quite frankly, that's just fine because that's where the return was for investors. If you wanted any kind of return on your assets, you really needed to move into high quality equities and not so much into fixed income. What we've seen over the last year or so, year and a half with the pandemic has been very interesting. 18 months ago when you looked at, when we first started seeing closures and stay-at-home orders go into effect, a lot of market participants were early on very concerned about what that would mean for credit quality, whether that's municipal bonds or corporate credits. And frankly, those concerns were pretty short-lived. On the municipal side, the CARES Act that was passed moved a lot of federal dollars into municipal entities. So really, a lot of the credits that we follow, we were seeing budgets that was able to shore up the shortfall in, say, sales tax revenue or hospital patient revenues or other revenue sources. So that really played a big role in where we are right now in the municipal market and seeing very solid entities credit-wise. And in the corporate side, we did see a pretty sharp fall off in economic activity, but as companies and the economy turned around, we've seen revenues increase, profits increase, and that's really helped to shore up the credit metrics that we see in the corporate bonds that we invest in. So that being said, we think, in the markets that we're involved in, we see a high rate of credit quality. And, kind of the flip side of that is then that, when you have this very high quality, issuer space that you're involved in, that also helps to keep interest rates and credit spreads, on the lower end of the range. So there's good and bad there. But I think that kind of leads us into, what's our strategy on the fixed income side. We continue to have a pretty defensive stance when we're making new investments. We're staying on the shorter end of the yield curve. That's keeping our durations low. It's also keeping maturities in portfolios coming due and returning principal over time so that as we do see interest rates rise, we do have principal that can be reinvested. So that's kind of our strategy. We're still, we feel strongly about that, where we're at in this market. But I do kind of want to tie back one of the points that I touched on earlier and John also brought up about moving, over the last few years, moving bond allocations into stocks. And in thinking how to do that, I remembered, because I've always kept this in my mind, I really like this analogy that Ron had probably 20 plus years ago after the dot-com bubble burst. He was speaking to a group of folks and he was likening a portfolio to a pyramid. And I really like that visualization of, the base or the foundation of that pyramid is fixed income assets or very safe assets, whether it be, bonds, CDs, or even cash. And as you move up in that pyramid, you can take on and add more and more risky assets. And why that was important at that time, and I hate to be talking about this when John was as well, hearkening back to that period, because I'm by no means saying that we're seeing parallels between the dot-com bubble and where we are today. But what investors, or many investors during that time period had happened was they kind of shifted that pyramid on its head. So you had at the very bottom now a very low allocation to safe assets, bonds, CDs, cash. And as you were going up, you're taking more and more incremental risk. I bring that up because, as devastating as that can be in certain times, it's also an important reminder, I think, to periodically take a look at your portfolio, especially in times like this when, many investors to seek, a good return on their portfolios have moved maybe more into dividend income stocks than they traditionally would have. It's a good time to just say, do I have the allocation to bonds that's appropriate? And, we want to say right now that it's okay to invest in bonds even though rates are low. We invest in safe assets so that if we see a pullback that John was talking about in the equity market, we have, sources of funds that we can move into the equity market. So I think those are kind of the comments that I wanted to share with you on the bond market. And I think, John, are you going to cover Q&A or, okay?
So I'll bring Bob on for Q&A in a minute, but the one thing I did want to talk about was our investment management team at Stonebridge. We've expanded the team pretty remarkably in the last 7 or 8 years, and we've added a lot more structure to the team as far as making good investment decisions on our clients' behalf. And we've always done a great job of having portfolio manager meetings on a weekly basis. But we've gotten to a point and we've grown so much that we thought it was important to set up a bigger structure and a more structured process. So in the last year and a half, we've created a dedicated research team. It's led by Steve Rorda, who has been with the firm a few years now. And on that team includes myself and Mike Dashner and Gory and Ryan, one of our newer employees in the last few years. Brad Stone is going to be joining that team as well. But we're really trying to dig into the names that we own on our clients' behalf in a much more formal process to generate new ideas. And I think most of our clients know we really have 3 distinct equity strategies at Stonebridge. We have a growth strategy, we have a growth and income strategy, and a dividend income strategy. And it's really tailored to what a client wants, right? If you're young and you have a long time horizon, you want to be more invested in growth stocks. But if you're retiring and need to live off all the assets you've earned over your lifetime, you want to be more in dividend income securities. And then we have a blend for that middle time period in life where you want some growth, but you're starting to need income. And when I joined Stonebridge almost 9 years ago now, we really had one equity strategy, and it was our equity strategy. And we really tried to distinguish between growth stocks and dividend-paying stocks. And our equity research team really tries to distinguish those three strategies to have some differentiated performance given what the markets have done. I will say that the last few years have been interesting because growth stocks have substantially outperformed value stocks or dividend stocks. That's changing, and it changes over time. You get in these periods where one outperforms the other. But our team is really focused on coming up with new ideas, new growth ideas that have good revenue growth and good earnings growth for our growth strategy. And then over here, also finding names that have good dividends, safe dividends, and growing dividends to increase income to our clients. But I wanted to make sure everybody knew that we're expanding the research team, we're expanding the investment team, and we're going to continue to do so as Stonebridge continues to grow. We have new leaders on the equity side. Mike Dashner is now the leader on the equity team. He's the director of equities. John Lynn is obviously the director of fixed income. Support staff includes Scott Shinnick, a portfolio manager and a fixed income trader. Jess is our equity trader. We've really built up our investment staff as we've grown, right? And when I joined Stonebridge, we had $850 million in assets. Today, we have over $1.7 billion in assets. And to sustain that growth and keep our clients happy, we need to reinvest, in our team and continue to expand and, really develop a good process for our equity and fixed income selection. So I just wanted to hit on that. I'm going to turn it over to Bob for some Q&A.
Thank you, John. Appreciate it. I've gotten some questions here, so I'll be sharing those with our panel, if you like, here in a few seconds. But thank you very much for your time. Want to be conscious of your time, but there were a couple of key questions that I think our clients wanted to have answered, so we'll go about that process. Y'all come a little closer to me. I don't bite yet. If you say something wrong, I might, but that's okay. Not right now. Yeah, I just want to make sure I got y'all in it here. All right. I'm going to start with Dan. Dan, you talked about inflation, and the media has focused a bit on the term transitory inflation. Can you tell us what transitory inflation is, and is this a situation where we might have that?
My definition of transitory is temporary. So if it's temporary, it means it's transitioning. You're not going to be there for very long. It's not permanent. It's not something that's going to be sustained. I would argue that there's certain elements of the inflation story that certainly were transitory, but I don't think it was all transitory. And I think what will come back to sort of drive the Fed's decision is the fact that some component of the inflation that we've experienced is probably going to be around for a lot longer than just temporary.
And Pat, you had a question that came to us as well, and this is sort of an economic yet sort of an investment question. So throw that at us.
Yeah. And just a reminder, if you do have questions and you are watching, please send them through the chat or the Q&A session, and we will make sure that we read those off. The question we received is, I understand that about 100,000 cars were destroyed in the recent hurricane. What kind of effect will this have on the auto industry?
Well, I'm guessing they will be replaced, which means that there'll be auto demand will be going up again, 100,000. So that means you might have a 1 or 2 month spike, but it doesn't necessarily mean that the demand will be there forever. So it's a replacement rather than just adding to the stock. So we'll see how it plays out. I think autos probably are going to make a bit of a rebound, but you were really selling a lot of cars earlier this year. And so you had a bit of a pullback for various reasons. You probably heard about the chip problem and all the things that made the supply of new autos far more difficult to come by.
Great. Thank you, Dan. John, you mentioned the dividend income strategy, and John Lynn also talked about where yields are on bonds. Tell us a little bit of what kind of income yield, and we're talking about income yield, not total return. What kind of income yield can you anticipate from a traditional dividend income portfolio?
Sure. So the dividend yield on the S&P 500 today, I think is around 1.6%, right? So if you're invested in the market, the dividend payments are about 1.6. In our dividend income strategy, we focus on names with an above average dividend yield. So we're looking for names that are at least yielding 2%, and go all the way up to like an AT&T, which is yielding 8%, but that's going to be cut, so it's probably around 6%. Overall, our dividend equity portfolios, the overall yield is just under 4% right now. So when you compare that to the bond market, John's already addressed our low rates, you're getting a much higher dividend stream in the equities that we would choose in those accounts versus what you'd get owning the bond portion or the corporate bonds from those companies. That isn't always the case through history, right? Most of the time, a bond of a company will yield more than the stock will. But today, we're in a period where many stocks' dividend yields are higher than that of their corporate bonds that are trading. We think that's a good thing. And dividend stocks not only give you today a preferred tax treatment, that could change, but you get a higher yield and you get possible capital appreciation if the stock does well to there. But 4%, just under 4% is what the typical dividend income portfolio would yield at Stonebridge.
And John, you talked about where we are with yields on the bond side, but it is still a critical part of a portfolio. As we look forward to prospectively higher interest rates, if the Fed raises rates, and let's say they get up to that 2% level, how would you structure a portfolio like that? Would you be willing to reach out a little bit longer than where we are now if we found the right credit at the right price?
That's a good question, and I think the answer is kind of yes and no. Our strategy has really remained the same, even in that range of, from 2% down to, 0.5%. I don't really want to get it too far into the numbers, but, I think that we would have to see a somewhat significant increase in yields. But then again, without getting too technical, we're also very conscious at Stonebridge of the yield curve. And that really is what the shape of the yield curve is really what shapes our strategy as far as where we want to be duration-wise. So I hope that answers it. I mean, I hate to say yes and no as far as the answer goes, but we'll have to wait and see kind of what the shape of the yield curve is once.
And it is challenging, reaching out a little longer in maturity for yield when interest rates are rising. I think most of you recognize that when interest rates rise, it has a negative impact on the price of a bond. So you have to be particularly careful about selecting a bond that you do want to hold long term.
Yeah.
Heidi, a question relative to the client relationship team, and just in general, the dedicated teams to our clients that we're forming. If you could just give a brief on that, let them know where we're headed in that direction.
Absolutely.
Step over here. These guys are hogging the limelight as always.
Absolutely. So one of the initiatives that our client relations team is taking is later this fall, we're hoping to send out a communication to everyone that really outlines your dedicated professional team that you have at Stonebridge. It will outline your portfolio management team as well as your dedicated client service team member. We're going to have all of our contact information, pictures, as well as what each specialty may be, so that hopefully we make it easier for you to know who to contact for what type of solution you're looking for, and also just make it more efficient for you to be able to contact us. We always love to hear from you. I know Elisa's team loves to hear from you. So we want to encourage that, and so hopefully this is one of the tools that we can do that with.
Great. Thank you, Heidi. Dan, I'm going to save the last question for you. Is there one more that you have? Okay, go ahead, Pat.
Yes. It seems that the current economy is being supported by the huge federal government debt. How long can this go on? How does the party end?
If I can add to the complication there. So this will be a 2 or 3 hour answer here by Dan. Question is obviously the buildup of debt and how does that happen? But maybe another question that, kind of gets into that. If we do pass a very large tax and spend bill that could increase our debt, how could that impact our economy? So,
Okay, well then, it could be 2 hours.
okay.
With
We
that
got
little
lots of time.
addendum that you
Yeah.
put on there.
Okay, good.
First of all, the party will end. It always does. You can't sustain debt-financed government spending forever. My favorite example, not necessarily my favorite, but my least favorite example of that is what happened to Germany after World War I. Germany basically tried to restore their economy by basically printing money. And when you finance government spending with debt, and you have the cooperation of the Federal Reserve to help buy that debt, you're effectively printing money. That's what you're doing. If you remember, Ben Bernanke said that one of the tools that the Fed had at its disposal was helicopter money. And what he meant was that we could just drop money from the sky. Well, when the Fed basically buys the debt that the government is issuing to spend, it's essentially the same thing as helicopter money. In fact, it's as close to helicopter money that the Fed can get to, and that's the problem. So that's unsustainable. That cannot go on forever. Eventually, and I can't tell you exactly when, but eventually, if they decided to do this on a longer-term basis, if they tried to continue to finance spending with just debt, then that's going to create a huge inflationary pressure down the road. There's going to be terrible problems. And again, back to Germany. I worked for Henry Wallach, who was from Austria. He lived through the inflation period of that period in Germany. And he said that there were times when it was cheaper to take the money you got paid with and use it to burn, to have a fire in the stove than it was to use it to buy the wood. So I don't think we'll get there, but just beware that that could be a problem. So it's unsustainable. When you talk about the programs that you have and spending, I've always said, and I'll say it again, that if you're going to have spending programs where you're actually set up new social programs should not be paid with borrowed money. Social programs should be paid with taxes. So if you're going to have social programs, you should only be able to afford those programs if you collect taxes to finance it. You shouldn't borrow money because you're basically providing, you're dividing up the spoils. You're saying, okay, we're going to have more, we're going to distribute a fairer distribution of goods and services basically by providing some kind of welfare. Well, then you need to take it away from somebody to pay this person. You can't just create it out of the sky and give it to them because now you got future generations that are paying for it, not current. So you only give away what you have. You don't give away what you don't have. So I'm sorry, but that's as longer than you wanted.
You got one more?
We do have another one.
Okay.
Any comments regarding the imminent default of bonds in Evergrande, the second largest real estate developer in China, on 9/20? Does this spark a global credit event, in your opinion, Dan?
In my opinion.
Yeah, that
I was
Dan.
looking over there.
We're talking
I'm going behind the curtain.
China credit default. Okay.
If they default, it certainly should be a problem for China. The question is, will it spread around the globe? I don't think it has the same repercussions. I don't think that maybe the mortgage crisis did in the US because everybody around the world owned some of those mortgage-backed securities. So I'm not sure it's going to have that same effect, but I would argue that it's going to have an impact on the financial markets in China if it hasn't already to some extent.
Yeah, I'll just add to that. I think you're absolutely right, Dan. China has always been an interesting place to invest in. When we used to see signs that they were growing at 10, 11, 12%, you weren't really sure if you could believe those numbers or not believe those numbers. China's controlled by the government, and it is, and it will continue to be. They're even doing a redistribution of wealth in China, where some of the most successful companies coming out of China, their profits are being taken to be redistributed. So it's hard to invest in China. We don't see a lot of, I don't think there'll be a lot of contagion to the US market if we do see that default. I do think there is real trouble there, and that will resolve itself over the next 6 months, but I don't think it's going to have a major impact and spread to other areas around the world.
Yeah, just to add on to John's comment, one of the things I think might be more disturbing for China is this push for more regulation and more government involvement in some of the activities that were basically served up as more capitalistic when they were put in place, and now the government's stepping in and doing what the communist government can do, and that's basically have far more to say about what's done. So I would say that's more of a factor. One other thing, when they were growing at 11, 12%, everybody thought they could do it forever. And there's no way they could do it forever because they had a labor force that was declining. The only way they grew at 11, 12% was because their productivity gains were 11, 12%, maybe 13%, because they actually had a declining labor force. So they weren't actually putting more workers to work. They were moving people that had jobs in the rural area, so-called jobs, and moving those people to the cities to put them into jobs that were more productive. And that's how they were able to grow their GDP as much as they did. There was a finite number of workers that they could move from the country to the city to get that done. So it's unsustainable.
We all set with questions there, Pat? Thank you. Thank you all for joining us this evening. We greatly appreciate it. We do need to thank our partners in this, particularly Victor at Matter. You Matter. If you get a chance, take a look at Matter. It's an unbelievable organization. Also want to make sure we thank our friends at Golden Valley Country Club who stuck with us when we went through different changes of how we were going to put this event together. We're in a room that could easily seat 400 people, and I think there's 10 of us here, and they accommodated that, and we greatly appreciate their service on that side. AV4U Video are the folks that are doing this recording for us and streaming. Contact them if you have something that you need to have videoed. They're a great group of people to work with. And a final note, the final note is you. We've talked about things that we're trying to do to grow, to serve you better, because we greatly appreciate the opportunity to serve you. Next year, because of you, will be our 25th anniversary of being Stonebridge Capital Advisors. We hope it's another 25 years, but that wouldn't happen without you. And we have lots of exciting things that we want to introduce you as we go through 2022, celebrating our 25th. So with that being said, I thank you all. Dan, you ran away.
Oh, I was trying to stay out of the way.
I thank you all. I thank you. Have a great evening. God bless.